that inflation and a lower dollar will mean that costs in the US will go up during next year, and inflation will go up much higher, and interest rates too. I'm absolutely certain about that.
Ladies and gentlemen, we had a difficult start today with some technical issues, but I welcome Egon von Greyerz there in Italy. My goodness, a new surrounding. I hope you enjoy it. And of course, we enjoy nearly every day rising gold prices. Egon, good to see you. We have to talk a lot of stuff as always.
Thank you, Jan. Thank you very much. Yes, I'm in Italy now, in Tuscany, and I haven't got the good connection right here, so I'm glad we could connect. I will get hold of Elon Musk so he can install the Starlink system for me instead.
Sounds like a plan.
Yeah.
Egon, last week, the Federal Reserve lowered the interest rate by 0.5 percentage point, and the reasoning, how Powell explained it, was pretty funny. Let me quote: "The US economy is in a good place, and our decision today is designed to keep it there," said Fed Chair Powell during the press conference. We have to look at the real state of the economy, but what would you say? Is he flat out lying in the face of the Americans and anything else? Anybody else?
Of course he is. First of all, Jan, they manipulate the inflation figures. The inflation is not at all at the level where they say. We're nowhere near the 2% level or around that. But they need to do that because the only way to survive for the US economy with a massive amount of borrowing, both corporate, private, and federal, is lower interest rates. Because the US has $100 trillion debt. And that, combined with high interest rates and a rising default level in all areas of debt, means that they need to get the interest rates down. So what they've decided is to sacrifice the dollar in favor of lower interest rates. But of course, that will hit them in the face sooner or later, because lower interest rates lower dollar will lead to more inflation eventually. So I expect next year inflation will go up, and therefore they will be forced to increase interest rates. So they're in a real dilemma, and wherever they go they lose, sadly.
But we win with gold and silver. Let's have a look at some hard facts, again from Games of Trades. I like this channel because he creates very nice graphics. First of all, Egon, we have here the monthly mortgage payment, the average payment that an American has to spend, that went up by nearly double between 2018 and 2024. How should one afford that? Next graphic, the personal interest payments, so from people, also skyrocketing. Then we see here the consumer debt defaults, still pretty low, but steeply rising. Here we have the same line in red, and the Federal Reserve interest rates. If it happens as it did here, there is a lagging effect. If they continue to lower the interest rates, the defaults will rise. And last but not least, I have here the unemployment rate. The unemployment rate is still low, but I think we can expect to go higher. I would not call that a healthy economy, not at all, Egon. And people are standing with the back to the wall. I think that's rather the reality instead of what Powell was saying.
Of course it is. The average American cannot afford to live with the real inflation rate. If you look at food inflation, it's probably 15%. If you look at rent inflation, it's probably around that level too, 15%. Insurance, all the costs are much higher than what they are saying. There's a shortage of places to live for most people in America, in Europe, in England, for example. You can't find anywhere to live at a reasonable price, because all the apartment buildings in most countries now are being bought up by big corporations, increasing the rent. So it's an impossible situation for normal people, and therefore, the economy is already in recession, and the stock market hasn't discovered it because the liquidity is big enough still and the money supply is big enough for stock market to still continue at or higher levels, but that's not going to last for long either. Yeah. So we are going to see the lag, as you talked about, and the lag will mean more unemployment, debts that people can't afford, and then eventually, as I said, more inflation. And it's an impossible situation that the US and the rest of the world cannot get out of, sadly.
And for a recession also speaks the mass layoffs. They are increasing a lot. Recently, we saw Intel, Amazon, banks, they are all cutting jobs. And people simply will not have the money to buy a lot of unnecessary stuff. So I think those prices of many goods will fall against gold, as we expected for a long time from the bubble assets already. But bubble asset, Egon, the market is still at record high, the Dow Jones. Maybe one or the main reason why our gold horse, the gold bull market, is still so much under the radar screen. That's only to show the Dow Jones 42,200 points, Egon. In this environment, that's a total disconnect, and as you say it, driven by liquidity, but less and less by real facts.
The stock market lives in its own little world, or big world, I would say, and doesn't reflect what's happening in the economy at all, just as you said, liquidity. And you mentioned gold. Of course, everything in gold is so much cheaper, but only 0.5% of world financial assets are in gold. So normal people, nobody holds gold. And that's a sad story. Everybody holds paper money, and that's going down in value by the day. And that's why people will suffer dramatically in the coming years.
Egon, I need to come back to the Fed because I forgot to ask you something at the beginning. Do you think those rate lowering, those rate cut by 0.5 percentage point was a panic action? Because we saw some comments in that direction. Many had expected 0.25% and now 0.5%. The same event or a similar event happened at the end of 2007, I think. And we know what happened after that. The market collapsed, and we know the history.
Absolutely. No, it is panic. And it's, as we said, you've shown the examples already. Defaults increasing, people can't repay their loans. With the Fed debt of soon 35 trillion and total debt of 100 trillion, the country can't survive. And therefore, the panic lowering rates, and then they're saying that inflation is low, which is not a fact at all. It's just manipulated inflation. But that's, as we said, it's a way to short-term survive for the banking system and the financial system and the mortgage system, etc. But it won't survive anyway. The defaults will increase dramatically. And eventually, as we said before, remember that eventually the higher inflation created by this lower interest rates and by also world markets, commodity prices will go up, etc. And therefore, that inflation and the lower dollar will mean that costs in the US will go up during next year, and inflation will go up much higher, and interest rates too. I'm absolutely certain about that.
Yes, I agree. Before we come to gold, Egon, let me give a little note to our viewers. You will be in Munich at Forum 1, November 7 and 8. Who wants to follow you, who wants to talk to you there, should come there. And now let's talk about gold. I have here an article from the Orr Report. Let me quote. The American Institute for Economic Research pointed out that gold is in the lowest cost, most marketable and least manipulable way to shift away from the dollar. Countries and investors have been leaving the dollar for gold or stocking up on gold since the de-dollarization movement reignited in 2022, reported US News. Central banks, for instance, have been buying record quantities of gold. In the first half 24, the central bank's demand for gold was 483 tons, the greatest ever reported, according to the World Gold Council. The total foreign exchange reserves that overseas central banks hold today, only 58% is in the dollar, a record low. The US news pointed out. The amount in gold, however, is up at 15% compared to 11% 6 years ago. That's a comment on exactly the movement that we discussed for many months here. Central banks increasing their gold stock also because they saw what can happen with dollar reserves, case of Russia. A market that is still driven by big players and central banks, while Joe Sixpack is standing aside, doesn't have the money to buy anymore. Egon, this is really a strange but a perfect bull market.
Yeah, no, already at the end of the 90s, we were forecasting that things are going to turn much worse for the world economy and for currencies. Therefore, in 2002, we went into gold for ourselves, our own company, our clients, in a quite a significant size, and we have kept on buying since then. And since 2002, gold is up 9 times in dollars, 9 times in euros. It's up in pounds 10 times, and in yen, I think 14, 15 times something, or maybe a little bit, 12, 13. So, gold but it's not gold going up, as we know. It's the governments destroying the value of paper money, as they have done throughout history. So there's nothing new in that, but normal people, politicians, leaders, they don't look at gold at all. Certainly not in the West. And for them also, gold is something that reveals their mismanagement of the economy. So that gives them even less reason to recommend gold to people. People in the East do it. In China, they do it. In India, of course, you have the tradition of buying gold. But the demand, as you say, the demand from central banks, as we have discussed before, is high now. It's going to increase as they swap their dollar reserves instead for gold reserves. That's happening. That's what's driving the gold price now. And it's going to continue. But there isn't more gold around. The world can't produce more than the 3,000 tons roughly a year. And we can't find any major amounts of gold anywhere in the world now, because it isn't available at these costs, and therefore the only way that gold can be supplied to more people around the world, more central banks will buy more, institutions will buy more, and individuals will start buying. So the 0.5% that now is owned by investors, or 0.5% of world financial assets into gold, that will increase. But that can only increase not by more tons of gold or more grams or more ounces, but only by a higher price. And that's what we'll see. People will get more gold, but that's more gold in money terms, not in weight terms. And gold still, well over $3,000 now, will in a few years' time be seen as an absolute bargain. $2,000, bit over $2,600 today, $2,700, and therefore, we're still at the very beginning of the gold curve, or at the beginning of the acceleration of the fall of the currencies. And that's what people have to remember. People waited for a correction now, like in 2008. That might come. There will always be corrections in moves, but they might come at a much higher level. So people who'd actually want to protect themselves should buy gold now, not wait for it to come down, because it might correct from a much higher level than today.
That's right. I agree with that, Egon. If we go to one of your articles, we have some interesting relationships to show the people where it came from. For a 400 ounces standard bar, you had to pay in 71 roughly $14,000, 2,100, 15,000. Here, $1 million, now probably even more than that. That is going to continue, I'm pretty sure, I will put an article in the description box. The Indians, for instance, they love gold, to say it plain and simple, and it's part of their culture. They continue buying. And then we have also the geopolitical tensions, Egon. You follow the news as I do. Lebanon, Ukraine, Russia. We have a dangerous situation, and that is also powder, of course, for the gold prices. So get your stuff. Also silver, which is now on the move. When we started talking, gold was at 1,300 and something. It's now double than that. That's a move that I expect to continue. So do not wait, as you just said, for big corrections. A final statement, Egon?
Well, I don't think the world and our views maybe, because they understand more than the average person, certainly. But the world as a whole doesn't understand what's going to hit it. The world doesn't understand that governments and central banks have destroyed, as they have done throughout history, over hundreds and thousands of years. They have destroyed the economy by running massive deficits and running up high debts. Now there is a time for repayment of this. And it's not going to happen. It's not going to be repaid. It can only be repaid by printing money. I don't think even the money printing will have no effect, because the printed money will be zero in value. And therefore, we are going to have, as we have discussed, we're going to have a panic reset, not just a normal government-led reset. It's going to be a reset where asset values collapse, where currency values collapse, and gold in nominal terms is going to go up, but it's not. It's only reflecting what's happening to the paper money, which is going down to zero again, and that is going to lead to major changes for the world. And everybody can't buy gold and can't afford gold, but anyone who has a little bit of saving should buy whatever amount of gold they can, or even silver, which is still only just over $30 an ounce. So everybody can afford to save a little bit every month or every few months in gold or silver, and that's going to be extremely useful in coming years when this economic cycle ends with crashes in asset markets and in currency markets. It's going to be not an easy time for people, but still, if you have a little bit of protection, it's going to help you a lot. And if you have bigger amounts of money, this is the only way to get away from a destruction of your assets. Holding gold and silver, property values and land values will not go up as they have done in the past this time, because they are very much part of the bubble assets. Long term, it's right to hold property, of course, but right now it's not the time to buy property, especially not if you do it on debt. So protect your assets mainly in precious metals, and then you can sleep better at night.
That was a good final statement. Egon, I thank you for today. Who knows where the gold price next month will be? We cannot rule anything out. Thank you for today. Enjoy your time in Italy.
Thank you very much, Jan. Thanks.
Thanks. Bye-bye.